Part of my job as a financial planner is to help people better understand debt and to have an effective debt strategy. That might not be a phrase that's often heard, debt strategy, because the word debt usually has negative connotations attached to it. How do you feel when you hear the words in debt or taking on debt? Does it sound good to you? Or does it feel like something you should avoid doing? If you're like most people, the latter response will probably be the natural one. But in this video, I'm going to challenge some of the perceptions you may have of debt and its uses in financial planning, as well as the biggest mistakes I've continually seen people make. You may well be falling foul of some of these common things right now, so watch on to see if anything sounds familiar. If you've landed on my channel for the first time, welcome along. I'm Chris Bourne and I'm a UK-based financial planner specialising in helping people achieve tax-efficient early retirement. If regular videos all focused on that subject are what you're looking for, then please subscribe, turn on those notifications, and let's get into it. One person's debt is of course another person or company's asset. If you've borrowed money, then it appears on your own balance sheet as a liability. But on the balance sheet of the person or company who loaned you the money, it appears as an asset. And thus, it must always be remembered that debt can be both a liability and an asset. The interest rate paid may be a cost to the borrower, but it will be an income to the lender. So instead of immediately thinking of debt in a negative way, it's important to see it merely as a financial instrument and nothing else. When you take this objective view, I think it's easier to recognise the difference between good debt and bad debt, which is a distinction some people fail to make, and it's the first major mistake I see. What do you think would constitute good debt? For me, it would be any debt that allows me to purchase an asset that I wouldn't otherwise be able to afford, which is likely to appreciate in value more than the debt has cost me by the time it's all paid back. I think we can all think of a good example of this, because this is the scenario that many of us fortunate enough to own our own homes have seen over the years. The mistake that I've seen many people make though is borrowing to buy liabilities that they think are assets. That's bad debt. One example of that is an expensive brand new car. We all know that as soon as your name goes down on that logbook, the asset that you've bought loses around 15% of its value. If you've bought a car for £25,000 and paid say a £2,500 deposit, the thing you've bought has immediately lost £3,750 of its value. So you might as well have burned that £2,500. What's worse though is if the £22,500 you borrowed suffered an APR of say 5% over 4 years, you'll end up paying £2,371 in interest to make your total outlay £27,371. At which point your car could have lost 60% of its original value and now be worth just £10,000. You've therefore made a loss of £17,371, and the loan has made the loss nearly 16% worse than it would have been. Now I know that most of us need to drive a car, and many people also want a nice car. We work hard and we want to enjoy some benefits and luxuries. There's nothing wrong with that. But personally, I try to lease anything that I need which isn't going to make me money. Let the depreciation be someone else's problem. Or I try to get 0% APR deals. Speaking of 0% finance deals, these are often worth utilising even if you've got the cash to pay. Unless you're going to get a discount for paying in one go, it would make sense to spread the payment out. Can you guess why? Well, let's have a look at an example. If we assume something costs £10,000 and you've got the cash to pay for it, you could of course pay for the item in one go. But if you were offered a 4-year 0% finance deal, you could put the money aside in a savings account and transfer the required payment across every month to your bank account, which based on 48 monthly payments would be £208.33. If you got an interest rate of 1.5% on the savings, at the end of 4 years, you'd have earned £318.51 in interest, even though the balance is diminishing. It might not sound like a lot of money, but I'm sure most of us would prefer to have it than not, and it would cost us nothing to get it. Another mistake I've commonly seen when helping to plan people's finances is an aversion to using debt at all, when it could actually enhance your return. This is what's called leveraging. To give you a straightforward example, let's say you bought a house as an investment project, which after all initial costs, including stamp duty and legal fees, cost you £250,000. And you were in the very fortunate position of being able to buy it outright. Let's then say you spent a further £10,000 on doing some light renovation works, and within a year sold it on again for £300,000. After you've deducted estate agents' fees, which we'll say are 1.5%, you've made a profit of £35,000 on your £260,000 investment, or 13.5%. Not bad at all. But instead of using all of that capital to purchase one house outright, what if you instead chose to buy 4 houses by placing a 25% deposit on each and borrowing the rest? Now, don't worry too much about the numbers for now, because some of these may sound unrealistic, but it's just to illustrate something. If you obtained interest-only mortgages at a rate of, let's say, 4%, the total payment on your borrowing of £750,000 would be £30,000 over the year, or £2,500 a month. If you spent the same £10,000 to renovate each property, that would be a further £40,000 cost. So your total outlay after the first year would be £320,000. However, if you then sold all of those properties for the same amount of £300,000 each and paid off the mortgages, taking away agents' fees, you'd have made a profit of £112,000, which on a £320,000 outlay is a 35% return. You've started with the same amount of money, but instead of making £35,000, you've made £112,000. More than 3 times the amount by leveraging. Now, let's be absolutely clear, that is a very oversimplified example. There are many factors that it doesn't take into account, such as your ability to borrow that kind of money in the first place. You'd need the income to substantiate the borrowing, not to mention the stress factor of concurrently managing 4 renovations, amongst other risks. But I've described that simply to illustrate why debt shouldn't always be avoided at all costs. If you follow the principles of borrowing to only purchase true assets and are able to weigh the cost of servicing debt versus the advantage of keeping more capital available for other projects, debt used correctly is a very powerful tool. A final big mistake I see is a very common one that almost all of us are guilty of at one time or another, and that's the danger of mental accounting. I saw a video by fellow financial planner and YouTuber James Shack recently, and he gave an example of a client who was falling foul of this. It reminded me that I had an almost identical situation with a client of mine who I gave the same advice to, which I'm going to share with you now as well. First of all though, what do we mean by mental accounting? Well, quite simply, it's the process of considering the costs associated with each investment in isolation, rather than taking a step back and looking at the whole financial picture. Let me explain with this example. My clients, just like James's, owned their own home, which was worth £1.2 million and had an interest-only mortgage of £225,000 on it at a rate of 1%. They also had 2 buy-to-let properties, one worth £838,000 with a mortgage of £350,000 and the other worth £570,000 with a mortgage of £300,000. The rates on both were 2.5%. So the total cost of borrowing across all 3 of these properties was £18,500 over the year, but the mortgage on the main home made up only £2,250 of that cost. Now, many people like to keep debt on their home separate from debt on their other investments because it gives them a feeling of comfort. But from a financial viewpoint, it doesn't make much sense. At the end of the day, money is money. Your total amount of debt is the same, regardless of the asset it's secured against. And that's what's meant by mental accounting. So what we were able to do in this situation is increase the amount of borrowing on the main residence to £600,000, still retaining the interest rate of 1%. And that then gave us £375,000 to pay off the other mortgages, reducing them to around £162,000 and £112,000 respectively. They were already on good rates for buy-to-let mortgages because the loan-to-value ratios were fairly low, so we didn't improve the rates any further. But the effect of this was a reduction in annual borrowing costs to £8,750, a £9,750 annual saving. Now you might say, why wouldn't you just go the whole hog and borrow the full amount against the main residence? Well, that wasn't possible on the basis that the mortgage is on an interest-only basis, and there are limits on what lenders will allow you to borrow and loan-to-value thresholds at which the rate starts to increase. So we went as high as we could while retaining the same low rate. That saving of £9,750 provided extra income that could be reinvested for my clients' retirements, an extra £49,000 almost over a 5-year period. But as we've been able to redirect that into pensions, it's actually a further £60,900 of investment over that period due to tax relief. In reality, all of the same options are available to my clients as there were previously. They still need to repay their interest-only mortgage at some point, but their general plan was to either sell one of their buy-to-let properties or downsize to finance this anyway. However, they've now been able to create additional investable cash flow to improve their situation further. So to summarise, the biggest debt mistakes I often see are buying liabilities with debt instead of assets, not using debt smartly to leverage your growth prospects, and mental accounting your way to paying more than you need to for debt. But if you want to know some of the biggest pension mistakes I see people make, then watch this video next. I run through the 3 most common pension planning traps that people fall into to help you avoid doing the same. As always, I hope that's been helpful, and I'll see you again soon.